Thank you very much, and thank you very much to Angelo and Tommaso for inviting me to this event. I always enjoy visiting Italy, so I only wish I could be there in person, but hopefully it won't be too long before I can do that again. Some of you may know me already. I'm Vice Chair at the Iasb, and I'm going to be joined in the presentation today by Mariela Isern from the Iasb technical staff, who's one of the main technical staff working on this project. Now, what we want to do in the next about 30 minutes is really to split the discussion into two broad areas. Firstly, I'm going to try to set the scene and give you some background. In particular, I want to try and explain the financial reporting issue that we're trying to solve and what we're planning to do to solve it. And then Mariela will go into more detail about the proposals in the exposure draft. So firstly, let's try and understand the problem that the board is trying to solve. So the entities to which the exposure draft applies are those that are subject to a particular type of rate regulation. Mariela, am I on slide 4? Yes, thank you. And that rate regulation establishes the compensation that the entity is entitled to charge customers for the goods or services supplied, and when, so the period in which that compensation is allowed to be included in the rates or the prices that are charged to their customers. And usually the compensation for the goods or services that are supplied is charged to customers through the rates in the period in which the entity supplies those goods and services. So typically, that means that revenue is recognized reflecting the compensation the entity is entitled to charge for the goods or services that are supplied. But in some cases, differences in timing arise, and the regulatory agreement requires the entity to include some of the compensation in the regulated rates for goods or services that are supplied in a different period. And when those differences in timing occur, the amount of revenue that the entity recognizes in a period applying IFRS 15, our revenue standard, includes compensation for goods or services supplied in the past or that will be supplied in the future, or doesn't include all of the compensation that the entity is entitled to for the goods or services supplied in the period, because part of the compensation was already charged in the past or it's going to be charged in the future. And this means that when those sorts of differences in timing arise, the revenue that gets recognized applying IFRS 15 in the reporting period gives an incomplete picture of the compensation for goods or services that are supplied in the period. And it's that lack of information which makes it difficult for users of the financial statements to really understand the relationship between the company's revenue and its expenses, and it makes it difficult for them to assess the company's prospects for future cash flows. Now, that all is quite abstract, so maybe just to set the scene, I'll use a really simple example to illustrate what I'm talking about. So let's take the most simple case you can imagine. So a company that's entitled to charge an amount that exactly recovers its costs and no more. So the rate that it charges in a particular period is based on what its budgeted expenses were. So that means if the costs in the period are higher or lower than the budget, then next year the amount they charge will be adjusted to make up for the difference between the budget and the actual costs that were incurred. So let's say the company underestimated its costs by 100. So in this period, it will charge 100 too little to cover its costs in this period. So if we do nothing about that, that looks bad in isolation. The entity really needs a way to explain to the users of its financial statements not to worry that there's a shortfall of 100 because they've got a right to recover that amount in the future. And that's basically what this project is all about. Giving extra information to users of the financial statements about the shortfall and the fact that it's recoverable through the rates by recognizing amounts in the financial statements. And as you'll see later, differences in timing represent rights to increase or obligations to decrease rates in the future. So those rights and obligations also, we think, need to be recognized in the financial statements so that the statement of financial position is also more complete than it is today. So going to the next slide, what we're saying is that without information about these timing differences that I was talking about, it's difficult for users of financial statements to really completely understand an entity's financial performance, its financial position, and also what to expect from future cash flows. And so the proposals are aiming to solve this lack of information by requiring companies to actually recognize regulatory assets and regulatory liabilities in the balance sheet and to recognize regulatory income and regulatory expense in the income statement. Now, the effect of recognizing regulatory assets and regulatory liabilities is that the entity's reported financial performance for the period would reflect the compensation that the entity is entitled to for the goods or services it supplied in the period. And that's precisely the principle that's underlying this set of proposals. So if you go back to my very simple example, in addition to recognizing revenue for the period, the entity would recognize an amount in the income statement for regulatory income of an additional 100 and a regulatory asset of 100 to explain to users of the financial statements that there is a right to recover that shortfall in expenses in the future. Now, the exposure draft calls this compensation total allowed compensation and defines it as the full amount of compensation for goods or services supplied that a regulatory agreement entitles an entity to charge customers through the regulated rates in either the period when the entity supplies these goods or services or in a different period. Now, going to the next slide. I said before that when differences in timing arise, the revenue that gets recognized in a reporting period gives us an incomplete picture of the compensation for the goods or services that are supplied in the period. Now, together with the information that's already required by other IFRS standards, such as the revenue standard, the information arising from regulatory income and regulatory expenses is designed to help users get a more complete understanding of the relationship between an entity's revenue and its expenses in the period and over time. So to give a more complete understanding of the entity's financial performance. And as I said before, it's not just in the income statement. Because this difference in timing and the right to recover an additional amount or the obligation to reduce future amounts gives rise to rights to increase or obligations to decrease the regulated rates in the future, we propose that regulatory assets and regulatory liabilities be recognised on the balance sheet to give a more complete understanding of the company's financial position as well. And we hope that ultimately, having a better understanding of a company's financial performance and financial position, as well as the information about the risks and uncertainties to which the regulatory assets and liabilities are subject, will help users to better assess the company's future prospects for future cash flows. And in addition, because all entities within the scope would be required to recognise regulatory assets and liabilities and regulatory income and expenses, we'd have comparable information between financial entities subject to the same style of regulatory rate regulation. So with that background, which hopefully gives you an idea of what we're trying to achieve and why, I'm going to hand over to Mariela, and she's going to go into some aspects of the proposals in a bit more detail. Thank you.
So I'll continue with the scope of the proposals. And the exposure draft says that an entity shall apply the proposals to all its regulatory assets and regulatory liabilities. The exposure draft then points out that regulatory assets and regulatory liabilities exist only if three conditions are met. First, the entity has to be a party to an enforceable regulatory agreement. The exposure draft defines a regulatory agreement as a set of enforceable rights and obligations that determine a regulated rate to be applied in contracts with customers. However, the exposure draft does not specify the legal form of the regulatory agreement. The exposure draft says that they might take various forms, such as a licensing agreement or a service concession agreement, and it also says that these enforceable rights and obligations can also be specified in statute, legislation, or regulation. Second, the regulatory agreement establishes the basis for how the entity must set the regulated rates charged to customers. And third and last, the regulatory agreement must create differences in timing, thereby creating regulatory assets and regulatory liabilities. So, as we have pointed out, one of the conditions required for the existence of regulatory assets and regulatory liabilities is the entity being a party to an enforceable regulatory agreement. And we are often asked what constitutes an enforceable regulatory agreement. The need for contracts or agreements that are enforceable is not new in Ifrs standards. For example, Ifrs 15, Revenue from Contracts with Clients, defines contract as an agreement between two or more parties that creates enforceable rights and obligations. In Ifrs 16, leases, for the purposes of defining the scope of that standard, the board decided that a contract would be considered to exist only when it creates rights and obligations that are enforceable. So in that sense, the proposal for requiring the existence of an enforceable regulatory agreement is not unique from this exposure draft. However, in some instances, it might require an entity to exercise judgment to determine that the rights and obligations arising from the arrangements that are in place are upheld, considering the relevant legal framework. Before discussing the proposed recognition requirements, I'd like to highlight briefly the key features of both regulatory assets and regulatory liabilities and link them with the concept of total allowed compensation. A regulatory asset arises because part of the compensation for goods or services supplied in the current period, this is the total allowed compensation, will be included in future rates and so will become revenue in the future. So in other words, a regulatory asset arises due to under-recovery of total allowed compensation in the current period that will be included in rates in a future period and therefore generates cash inflows in that future period, like in Sue's simple example. A regulatory liability arises because revenue already recognized includes part of the compensation for goods or services to be supplied in the future. So in other words, a regulatory liability arises due to over-recovery of total allowed compensation in the current period that will be deducted from rates in a future period and therefore generate lower cash inflows in that future period. So let's move then to recognition. An entity would be required to apply the proposals to all its regulatory assets and regulatory liabilities. So when there is uncertainty as to whether a regulatory asset or regulatory liability actually exists, an entity recognizes that asset or that liability only if it is more likely than not that it exists. In some cases, to decide whether a regulatory asset or regulatory liability should be recognized might require judgment. The slide provides some facts and circumstances that might be considered. For example, having the confirmation from the regulator, regulatory decisions or court rulings interpreting a regulatory agreement, the entity's experience with a regulator's interpretation of the regulatory agreement in similar circumstances, the experience of other entities regulated by the same regulator, or preliminary views expressed by the regulator. So the list is not exhaustive. Moving now to the main concept in the exposure draft, the total allowed compensation. So the exposure draft identifies three components of total allowed compensation. First, compensation for expenses that an entity incurs when supplying goods or services, and that a regulatory agreement entitles the entity to recover. The exposure draft refers to such expenses as allowable expenses. In some other cases, an entity will be required by the regulatory agreement to pass through the customers amounts of any income that the entity earns, for example, gains on the sale of an asset. And the exposure draft refers to such income as chargeable income. The second component that you see in the slide is target profit, and mainly in the form of regulatory returns on the amounts invested in the assets that the entity uses to supply the goods or services, or in the form of performance incentives, bonuses, or penalties. And there is a third component, which is regulatory interest. Regulatory interest income on regulatory assets or regulatory interest expense on regulatory liabilities would reflect an entity's compensation or charge for the time lag between the origination of a regulatory asset or regulatory liability and their recovery or fulfillment. The exposure draft provides guidance to help an entity determine whether each component relates to goods or services supplied in the current period, or whether that component relates to goods or services supplied in a different period. And this is precisely what this slide outlines, is when the components of total allowed compensation affect profit. That is the period in which that component would be reflected in the statement of financial performance. And we would like to focus on the second component of total allowed compensation, target profit, and more specifically on the regulatory returns. The exposure draft treats regulatory returns that a regulatory agreement entitles an entity to add in the rates charged in a period as forming part of the total allowed compensation for the goods or services supplied in the same period. This means that the regulatory returns that an entity is entitled to add in the rates in a period would be reflected in profit in the same period. For one case only, the board concluded that returns to which a regulatory agreement entitles an entity to add in the rates in a period should form part of total allowed compensation for the goods or services supplied in a different period. This case is when an entity is entitled to include in the rates returns on an asset that is not yet available for use, because, for example, it is being constructed. And this case is illustrated on slides 15 and 16, the next two slides. So during the project, we learned that regulatory agreements typically use two approaches for providing entities with returns on an asset not yet available for use. This slide illustrates the approach in which these returns are included in the rates charged to customers during periods when the asset is not yet available for use, for example, during the construction period of an asset. And we have heard that this is a regulatory approach frequently used in some jurisdictions in Europe. In this case, the regulatory returns are included in revenue during the construction period. Applying the proposals, the entity would be required to account for a regulatory liability and corresponding regulatory expense during the construction period as a consequence of a regulatory return being provided to the entity in respect of an asset, even though that asset isn't yet available for use. This means that the proposals would not consider that these returns form part of the total allowed compensation for the goods or services supplied during the construction period. And the board decided this because during the construction period, the entity is not yet supplying goods or services with that asset. Applying the proposals during the operating period, the entity would fulfill that regulatory liability as it supplies goods or services with that asset once it is in use, and by doing so, would be reflecting these returns in profit during the operating period for that asset. This slide illustrates the second approach that is used in regulatory agreements. Under this approach, the regulatory agreement gives an entity a right to accumulate regulatory returns for an asset being constructed that isn't yet available for use, and to include those accumulated returns in the rates to be charged to customers once the asset is available for use. So in this case, the returns are included in the rates when the asset is in operation. And this regulatory approach is commonly used in Canada and in the States. Also in this case, the exposure draft proposes that any returns on an asset under construction form part of the total allowed compensation for the goods or services supplied once the asset is available for use and not during the construction period. So applying the proposals, these accumulated regulatory returns would form part of total allowed compensation during the operating phase of the asset. Again, this means that during the construction period, the total allowed compensation for goods or services supplied using the asset is nil, and therefore there is no regulatory asset. And in this case, because the regulatory returns accumulate during the construction period, they are not charged to customers and hence are not recognized in revenue during the construction period. This means that there is no regulatory liability either in this construction period. We move now to measurement. And the exposure draft proposes to measure regulatory assets and regulatory liabilities using a cash flow-based measurement technique that includes an estimate of all future cash flows arising from a regulatory asset or a regulatory liability and discounts those estimated future cash flows to their present value. Throughout this project, we have learned that cash flows arising from regulatory assets or regulatory liabilities are typically fairly stable and predictable. However, in some cases, the amounts might be subject to some uncertainty because of demand or credit risk. In those cases, an entity would estimate future cash flows using either the most likely amount method or the expected value method, depending on which method the entity concludes would better predict those future cash flows. Also, the exposure draft proposes that an entity updates its estimates of future cash flows if changes occur. The model involves discounting all of the cash flows arising from a regulatory asset or a regulatory liability, including those cash flows related to regulatory interest, and in most cases, using the regulatory interest rate as the discount rate. There is only one case when an entity would not use the regulatory interest rate as a discount rate, and this is when the regulatory interest rate for a regulatory asset is insufficient, and we will cover this case in the next slide. The exposure draft also proposes that the discount rate established at initial recognition would be kept unchanged unless the regulatory agreement changes the regulatory interest rate. So, as I said, usually the regulatory interest rate is the one used as the discount rate. However, when there is an indication the regulatory interest rate provided for a regulatory asset might be insufficient to provide an entity compensation for the time value of money and uncertainty in the cash flows, the entity would be required to estimate the minimum interest rate that would provide such compensation and use that rate for discounting if that minimum interest rate is higher than the regulatory interest rate. Because regulated rates are typically designed to support entities' financial viability, such situations are expected to occur infrequently. We can move now to presentation and disclosures. So presentation. Overall, the proposals in the exposure draft are designed to supplement other IFRS requirements, and consistent with this, the proposals do not override the presentation requirements of other IFRS standards. In the statement of financial position, the proposals require regulatory assets and regulatory liabilities to be presented in the balance sheet in separate line items. An entity would present current and non-current regulatory assets and current and non-current regulatory liabilities as separate line items in the balance sheet, except when the entity presents all assets and liabilities in order of liquidity. In the statement of financial performance, the proposals require that the net movement between opening and closing balances of regulatory assets and regulatory liabilities to be presented as a separate line item immediately below revenue. And the exposure draft refers to this line item as regulatory income minus regulatory expense. Moving to disclosure, the overall disclosure objective proposed by the board focuses on providing useful information about the effects of differences in timing on companies' financial performance and financial position. An entity would be required to disclose in the notes information about regulatory income and regulatory expense, which together with the information provided by applying other IFRS standards would enable users of financial statements to understand the relationship between the entity's revenue and its expenses as completely as they can when there are no differences in timing. That is, when all of the compensation for the goods or services supplied in a period is included in the rates in that same period. An entity would also be required to disclose information to enable users of financial statements to understand the entity's regulatory assets and regulatory liabilities. And that understanding would provide users with insights into how those regulatory assets and regulatory liabilities affect the entity's future cash flows. Moving now to the proposed disclosure requirements, an entity would be required to disclose a breakdown of the amount presented in the line item regulatory income minus regulatory expense. As already mentioned, that line item would be presented immediately below revenue and profit or loss. The board proposes this requirement to enable users of financial statements to understand the components and causes of regulatory income and regulatory expense. Examples of components and causes of regulatory income or regulatory expense are additions or recovery of regulatory assets, additions or fulfillments of regulatory liabilities, regulatory interest income or regulatory interest expense, and other items affecting the measurement of these assets and liabilities, such as changes in estimates of future cash flows. An entity would also be required to disclose a maturity analysis of the regulatory assets and regulatory liabilities that are outstanding at year-end, and disclose an explanation of how risks and uncertainties affect the recovery or fulfillment of those assets and liabilities. The exposure draft also proposes that an entity disclose information about the discount rates used in measuring regulatory assets and regulatory liabilities. An entity would also be required to disclose a reconciliation from the opening to the closing balances of regulatory assets and regulatory liabilities. And with this, we finalize the presentation of the aspects of the model that we thought would be of most interest to today's audience. I'll hand now over to Sue to conclude.
You've still got plenty of time to prepare your comments. The comment period deadline ends on the 30th of July, 2021. It's fantastic to hear the feedback in these outreach events, but in addition to that, we really do love to receive comment letters as well. And all your input is really important to us to help us really make sure we understand the issues, including the operational issues for the industry, and to develop the best possible proposals that we can to assist with providing better information to users of financial statements. Our ultimate objective is to replace IFRS 14, everything going well. I'm going to leave today's event now because unfortunately I don't speak Italian, and I know you're going to continue your discussion in Italian, but Mariela is going to continue listening and she will give me feedback from the event, and I very much look forward to hearing that. So thank you for listening to me today. And at this point, I'm going to hand you over to Chiara's very capable hands, and she's going to present IFRAG's views on these proposals. Thank you for listening.